Hello guys, and welcome to this new Forex Live Academy video. In this video we are talking about one of my favorite tools for analyzing of Forex trading. Today we talk about MyFxbook. MyFxbook can be a great tool to analyze Forex trading strategies, but it can be also a huge trap if you don't know what to look at. We can go over all features of MyFxbook because it will just take too much time. But in fact, you need only a few key statistics to analyze is it a good strategy or not. Okay, let's jump into it and I show you the first thing that you should pay attention to. So when you open the track record from MyFxbook, you have the main statistic and you have some key data on the left side of the graph and below the graph. The first thing you should look at is how long is the tracking period. So is it an actual tracking or is it the old one? And how long is the time that trading takes place? To really make an opinion about the strategy, I would say you need at least 6 months of history. Because in this period, this strategy went through different market situations. A short track record about 1 or 2 months doesn't really say anything about the strategy. But the longer the strategy is working, the more you can see how it reacts on different market situations. If you have a short track record with very good performance, it just can be luck. But 6 months and longer is a good base for the analyze. So on the top left, you see the big, hopefully green number, which is the gain of the profits. So there you see how much percent the strategy gained over this period. A little bit down below the gain, you see the most important statistic. And that is the maximum DD, this is the maximum drawdown. The maximum drawdown defines the risk of the strategy, and like I said, this is the most important point. I will explain this point a little bit. So what is a drawdown? A drawdown defines how low you allow to drop your open position, so how much they go in minus with the open position. It's also significant with which lot sizes they are trading, but lot size is another topic, we will discuss it in another video. But what is a good drawdown and what is a bad drawdown? I would say everything below 10% is great. So when you have a long trading history and the maximum drawdown was below 10%, this is a fantastic risk management. Everything between 10 and 20% can be okay, but everything above 20% is very dangerous. There are some studies that show that strategies with a drawdown bigger than 30% will end up in a crash. Because the bigger your drawdown is, the more you have to compensate with new open positions, but in one time you run just out of margin. So I would recommend hands off of strategies where the drawdown is bigger than 20%. And this small statistic shows the maximum drawdown that this strategy allowed in the whole period. But you can see also the average drawdown. You just click on the top right on drawdown and then you see all the drawdowns through the period. So when we are at this point and the drawdown is okay, the period is okay, the gain is okay, we take a look at the chart flow himself. So at the chart flow we have the graph, okay? And on the graph we have two lines. This is a red line, this is a yellow line, and we have two kind of bars. There's the green bars and the red bars. For the explanation of the graph, we will use this flip chart here, and I try to draw some graphics on there. First of all, let's start with the bars. So this is the gain ale and this is the time ale. And through the time you have the green bars, for example like this, and you have the red bars which go downside. Then maybe some green bars again. And some red bars that goes down. Now, what are these bars? These bars shows the amount of pips that the strategy made on this time. So the green bars is the positive pips and the red bars are the negative pips. To save some time, I will also not explain what is a pip. For this topic, we will also make an extra video where we explain what exactly are the pips. Okay, back to our graphic. In this case, when we analyze the pips, there is also a very big trap. First of all, it's not bad at all if sometimes you made red pips, so negative pips. This can and should happen in every strategy. But some people think that if you have huge gaining of pips, that you make very good profits. That's just not true. Let me give you a short example why 10 pips can make the same result like 100 pips. When you open a trade, for example, with one lot and you gain 10 pips, you have this amount of gain, the percentage. But if you open 10 0.1 lot trades at the same time and you gain the same 10 pips with every trade, in the graphic you made 100 pips. But the result is the same. That's why when you analyze a strategy, don't look how much pips they made, because this says nothing at all about the strategy. The only thing on the pips side, what you should look at is the summary of the pips, of course, will be positive and not negative. Okay, now let's talk about the lines that you see on the graph. You have two lines. You have a red line, this is the gain line, okay? Maybe like this. Something like this, okay? And then you have a yellow line. But yellow you will not see very good on the whiteboard. That's why I will use blue. Okay, so in our video, blue is the new yellow. But before we go to the yellow line, there is also one thing you should look at on the red line. So what is the structure of the strategy? And you can see this exactly with the line. For talking about this, we just take a new slide and just draw some strategy lines. Right now we can also build in a small quiz. I will draw now 3 different strategies here with the red line, only with the red line, and only with that you should recognize which strategy is a bad one and which strategy is a good one. Okay? Let's start. So, what do you think? Which of this strategy is a good one and which one is a bad one? And now I will show you the solution. Look. This one is good. And this one is good. This one, I would say, is bad. I explain you why. So every strategy has a kind of template that you see, okay, there is a structure in the strategy. It makes all the time the same things. For example, here is a clear structure of small little steps which go their way and it's working. Also here you see a structure that can be a structure of a breakout strategy, for example, that you test the market and then when you get the right hook, then you have a breakout where you make the profit. Then sometimes you have a testing phase and you have again the breakout. Also here, so it's like a breakout strategy, but the key point is you have a template, you have a real strategy here where you're working with. Here, it seems like there is no template at all. This is just trying to do something and get lucky when you make the profits or not. Of course, also this strategy can be very bad if the next line, so the equity line, is not right. And about the equity line, we will talk right now. So the first look on the red line is our first impression about the structure of the trading style. Now it gets very interesting and we come to the yellow line. This is the equity line. So this is the real amount minus the open positions. And like I said, our yellow is blue. That's why I will draw this with blue, but in MyFxbook this is the yellow line. So a very good sign is when the yellow line is very, very close to the red one. Of course, there can be sometimes low dips where it goes like this, but the closer it is, the better the risk management of the strategy. So the closer these two lines are together, the better is the risk management and the better is the strategy. To make this a little bit more clear, let's switch to our other strategies and I show you some possibilities of equity graphics. So the ideal equity flow will be, for example, in this strategy like that. If it goes exactly the same way like the gain, like the red line. But to make this is very, very, very difficult, and if you want to have a good profit, you should risk a little bit, and this is completely normal. If you have a small, really small drop downs of the equity, but the less, the better. If you see an equity going, for example, like this, and it goes in the other direction than the profit, you get a huge drawdown. And this is a very, very bad strategy, because you can maybe have a win of 100%, but the equity is already at 30%. This is almost a dead account. Or, for example, equity lines, if we take this here, which go huge down and make big jumps to the bottom line and then big jumps up again. This is also a very, very dangerous, because this is a sign of martingale. What martingale is, we will talk about that later, but this is also a dangerous strategy that will not last for long. So back to our main chart. So there are many people out there who want to show you strategies, and they try to fool you when they show you only the gross profit and they show you only the gain that they made also in the monthly gain. What you see on the bottom line of the chart, you see the monthly percentage. They show you only the monthly percentage, and they show you maybe only the complete gain, but never show you the equity and how the trading was made, because this is the key factor to analyze is it a good strategy or not. So that were the most important points where you should look at when you want to analyze a MyFxbook chart from a forex strategy. But there are also some less important points where you should take a look at. For example, on the bottom you see the amount of trades that were done in this period. My personal opinion and my experience showed me that the real good profitable trading is done with very few trades. When you have thousands of trades, for example, they make 500 or 1000 trades per month, it's mostly done by an EA, by an expert advisor. It's a trading bot, and in my opinion these systems never work for a long time. But how good or bad EAs work, about this topic we will vote also in our community, and if you like to see it, I will make a video about EA trading bots. On the left side you also see the profitability graph. Here you see a win-lose ratio, so of all your trades that you make, how much trades did you win and how much trades did you lose. And here is also an important point: only winning trades is not good at all. A 70-30 or 80-20 ratio is very, very good, but also a 50-50 ratio can be very good. But if you have only winning trades, this is a very, very risky strategy, because there you will probably very sure have a huge drawdown. It's almost impossible to close every trade in profit with a small drawdown. Also, take a look at the profit factor. The profit factor defines the gross wins against the gross loss. For a good strategy, the profit factor should be over 2.0. So right now, with these key indicators, you can analyze the most MyFxbook charts and the most traces, and you can decide, okay, is this a potentially good strategy or is it a dangerous strategy which will end in a crash? So with your new learned skills, you can also analyze our strategy that you will find in our community. All the links to our community you will find in the video description. And if you like the video and you want to see more educational content, then like I said, take a look in our community on Telegram. You can also vote and decide which topic will be the next that we present. And yeah, leave us a like, leave us a subscription, support us on Instagram, Facebook, YouTube and Telegram. And yeah, thanks for watching. We'll see us in the next video.